Welcome back to The Explainer. Today, we're diving into a really interesting chart pattern that traders watch for, especially after a big market move. It's called the flag. We're going to break down all the complex chart stuff into a simple, visual guide so you can see exactly what it's all about.
So imagine this. A stock you're watching suddenly spikes, or maybe it just plummets. What do? I mean, that's the classic dilemma, right? Is it too late to jump in, or is this move just getting started? For a lot of traders, the answer might actually be hiding in plain sight, right there in the shape of the chart.
And one of the most common clues they look for, one of these so-called continuation patterns, is known simply as the flag. So what's so cool about the flag? Well, the whole idea behind it is that it suggests the market is just catching its breath, It's taking a short pause, what analysts call consolidation, before it potentially keeps going on its original powerful trend.
Now, to really understand these things, you gotta know that flags come in two main flavors. They're basically mirror images of each other, but they each tell a very different story about where the market might be headed.
The most important thing here is context. It's everything. A bull flag, that shows up during an uptrend, and it's a signal that there's probably more upside to come. A bear flag, on the other hand, appears in a downtrend and suggests, that the price might just keep on falling. It's all about following the direction of that main trend. Okay, let's take a look at this chart here. See that sharp, almost vertical climb? That's what traders call the flagpole. Then, it's followed by this little, slightly downward drifting channel, and that's the flag itself. This little pause suggests that all that initial buying pressure is still there. It's just taking a little break while some of the early buyers cash in.
And here, this chart shows you the total opposite. You've got a steep drop, that's the bear flagpole, and it's followed by a really short rally that creates the flag. This pattern suggests the sellers are just kind of regrouping before they potentially push the price down even lower.
So, spotting these shapes is one thing. But how does a trader really know if it's a legit flag pattern? This is where you need a much more structured, rules-based way of looking at it. It's absolutely critical.
Right, because let's be honest, not every little pause in the market is a flag. The work of technical analyst Chaim Ruin gives us a really specific set of rules to help separate a real, valid pattern from what might just be random market noise.
Okay, so according to this framework, there are a few rules that are absolutely key. First, the flagpole has to be a sharp, really strong move. The flag itself, that has to be a tight little consolidation where the price actually touches both the top and bottom boundaries at least twice. And, this is critical, it all has to happen pretty fast, within about 3 weeks on a daily chart, before a breakout finally confirms the whole pattern.
And here's where this methodology gets really powerful. This rule, it's often called a measured move, it gives traders a way to estimate a potential profit target. The whole idea is you measure the height of that first flagpole, and then you project that exact same distance up from the point where the price breaks out. Pretty neat, huh?
But, and this is a big but, let's be super clear here. No chart pattern is ever a guarantee. Just like any tool in technical analysis, flags are not foolproof. They can, and believe me, they often do, fail. As Chaim Ruin puts it so directly, no pattern is a crystal ball. And you know what? Understanding how and why these patterns can fall apart is just as important as knowing how to spot one in the first place.
So what are the big warning signs to look out for? Well, a breakout that happens on really low trading volume is a huge one. It just suggests there's no real conviction behind the move. Also, if that consolidation period drags on for more than a few weeks, the pattern's predictive power really starts to fade. And maybe most importantly, because failure is always on the table, strict risk management, I'm talking about using stop-loss orders to get you out of a losing trade automatically, is just absolutely essential.
All right, so after breaking all this down, what's the real takeaway here? What's the actual value of using a pattern like the flag?
Well, some studies suggest that really well-formed flag patterns, the ones that follow all the rules to a T, they can have a surprisingly high success rate, sometimes up in the 70 to 80% range. Now, of course, that is never a guarantee, and it depends a ton on market conditions, but it really does highlight the pattern's potential as a pretty reliable signal.
And that, right there, really is the bottom line. The true power of the flag pattern isn't about perfectly predicting the future. It's about giving you a solid framework for managing your risk. It gives a trader a clear entry point, a logical target for taking profits, and, most critically, a definite exit point if the trade goes south.
Ultimately, patterns like the flag force all of us to think about a central question in trading. Where's that line between objective, rule-based analysis and the subjective art of just reading a chart? It's something worth thinking about every single time you think you see a pattern in the price.